My name is Jay Trumbower, CEO, Barton Walter Krier. We are CPAs and business advisors. This is my 11th annual and FEI's 11th annual Capital Markets M&A update. So really, thank you for the turnout today. Apologize on the front end. We have a full house. Hopefully the lines for food weren't too bad. It looks like we've got plenty of seating, a few left up in front if you're coming in. And we're going to get going. We got a great day planned. 192, I was told, registered attendees. And by what I see, there's not a lot of no-shows, so that's a wonderful way to start the year. You know, our event today is a joint event between FEI Twin Cities and PDA Minnesota. Both organizations have great members. FEI focuses on experienced accounting and finance professionals. PDA focuses on board of directors for privately held companies. You can find membership information at the registration tables. Please take a look at it. I think you'll enjoy being part of these organizations. I'd also like to thank our strategic sponsors for both organizations. The SPs are important to the sustainability of our chapters. Information about the PDSPs can be found on the tables, also at the registration tables, and you'll see a lot of board members here to help. So with that, I'd like to actually have the board members of FEI that are here stand and be recognized. Thank you. I'd also like the PDA executive committee members that are here to stand and be recognized. There's a few. All right. George in the back. All right. I'd like to thank Brad Pappas, our executive director of FEI, for pulling all the logistics and everything together. His assistant, Mary Sitch. Mary must be out by the registration tables. Thank her on the way out. Wonderful job. And both organizations have a fine national office that also provides support, and we work with to make these things happen. So I think that's it for announcements. Check out the organizations. There's plenty of materials around, both on the tables and at the registration tables. And I'm going to take a break and go to the back. But my good friend Joe Housman, Brown & Brown, we've been together doing this for, 6 years now? Something like that. Who counts? Anyway,
sounds about right.
He's a longtime FEI member, board member, and does a great job with these things. So why don't you take it over, George?
All right, thanks, Jay. Sounds like the sound is good. My name is Joe Housman. I'm a vice president at Brown & Brown. I focus on business development. As Jay mentioned, Brown & Brown is a strategic partner. Brown & Brown is we specialize in risk management and consulting.
Will Becker, Managing Director at Chartwell. I'm in our corporate finance group. Chartwell is a local-based financial advisory firm. We specialize in valuations, privately held companies. We're a boutique investment bank doing transactions, helping business owners figure out what to do with their companies, and then ultimately execute on those strategies. One niche that we have in the marketplace is we work with a lot of ESOP-owned companies. About half of our work is related to employee-owned companies and their transactions. I'm going to talk more on the middle markets. Oh, there we go. And you'll hear some common themes, but you know, the middle market private company M&A space is a little different than the public markets, but following some of the same trends. So to kick it off, here's the middle market M&A deal count. So you can see, obviously, a pretty sizable decline, both in 22 and 23. So in 22, coming off of 21, which was just a hectic pace. If you think back to 21, we were coming off of COVID. You had business owners who said, I don't want to go through that again. Ready to get out. We had interest rates at incredibly low levels, almost, free money, if you will. You had private equity with a lot of capital to deploy, You had stimulus money that went out into the economy. We had strategic buyers with very strong balance sheets. All of that converged into an incredible pace of activity in 21. So we get to 22 is a bit of a coming off of, that pace. I think some of the deals were pulled forward into 21, and so we start seeing, a leveling off in 22, and then we start seeing interest rates rise. And then you get into 23, and interest rates continue to increase. We have concerns of recession. We have geopolitical issues going on. So 23 was a significant pullback in deal activity. And if you look at deal volume, same trends, right? Basically down 30% year over year in both 22 and 23. What's interesting here is we don't have the numbers up, but the average deal size also came down in 23. So on average, this is middle market again. On average, the deal size over the last 10 years averaged right around $110, $125 million. In 23, that average fell to 107. So not only are we seeing decline in numbers, we're starting to see smaller deals, either more smaller deals, or we're having pressure put on the valuations. A lot of this is driven by the debt markets. So overall, the middle market M&A is driven by largely private equity. And so when we see higher interest rates and we see pullback from the credit markets, that has an impact on the overall middle market M&A. So in 23, you'll notice that the debt to transaction multiple of 2.9 times is the lowest that we've seen since 2014, dip below 3 times. The prior 2 years were 3.3, 3.2 times. So basically, there's less debt to be put into these deals, meaning private equity has to write bigger checks. So their contributions increased in 23 to basically 53% of the transaction value. So what that means, we have a private equity panel later, and I'll be curious what their thoughts are. They're writing bigger checks, meaning their returns are going to be lower. And so with that, we started seeing some pullback in the markets. The secondary loans or mezz market remain pretty stable, just slightly less than 1 turn of EBITDA on these deals. So again, private equity, huge driver of the space. Same trends. You're seeing declines in both 22 and 23, both in volume and deal count. And what you're also seeing, and it's actually amplified here, is the deal size. So again, in the overall market, that deal size was on average 105 to 120 million dollars. It's actually higher on average for private equity deals, more in the 110 to 140. But we saw a bigger drop off in 2023. So the average dropped to 97 million. And so part of that is driven by, again, valuations, but also we're seeing more add-ons, and I'll talk more about that in a moment. So there's still a tremendous amount of dry powder out there, and it continues to increase. So private equity funds continue their fundraising, they're raising capital. But of course, in the last 2 years, we're seeing a drop-off in the M&A transactions, so that means less capital is being deployed. So it continues to build. This is a good thing for the M&A markets, meaning this capital has to be deployed. So I was encouraged to hear Kurt talk about optimism that interest rates will be coming down in '24, which if we have a lowering level of interest rates and we have increased activity in the capital markets, combined with this amount of capital sitting on the sidelines, we should start to see a reverse of that trend in the M&A markets. I mentioned add-ons. So private equity, the theory, kind of the investment thesis for private equity is to acquire a platform company and then help accelerate growth through add-on acquisitions. Those platform acquisitions generally are completed at higher multiples, and then the platform, or I mean the add-on transactions are generally at lower multiples, bringing down your average multiple. And because of the lower number of lower number of M&A deals in the last couple of years of primarily platforms, we're seeing a large number of add-ons being added to these portfolios. So you can see that roughly 76% of all the private equity deals were add-ons. So these transactions actually help propel the overall market. Without them, we would have saw a much larger decline in activity. Overall multiples have come down as well. So with the credit markets tightening, with private equity being required to write bigger checks, it does have an effect on the overall pricing. So within the PE market, we saw this pullback, but we're still at levels that over the long term are still pretty attractive. So still a lot of capital pushing deals out there, but you have business owners who, have this expectation in mind from, the prior 2 years, especially 21. And so, there's a reluctancy to go to market when the multiples are coming down. And, we've had conversations with a number of business owners who've, entered 23 and we start talking about, the impact of the market with multiples being compressed, and a lot of it's due to high interest rates. So a lot of those business owners have made the decision to just sit on the sideline for a year, wait for those interest rates to come down, and hopefully the valuations to start coming back up to meet their expectation. We see the same trend in the overall M&A. The previous slide was primarily private equity. Slightly higher multiples overall because now we're taking into consideration strategic buyers. So strategic premiums being paid pushes that multiple up. But similar trend in 23. We have compression of those pricing multiples, and so again goes into the consideration for business owners who are trying to figure out what's the right time to sell. So we also break down pricing multiples as it relates to size, and there is a correlation between pricing multiples and larger deals. So the gold bars here are those deals 250 million and above. And the very low end here is deals in that 10 to 25 range. So you can see it's quite a divergence from, 5.8 to 11 times, right? We get this a lot with business owners who hear about, the previous slides you saw 7 times, 10 times, and even the upper end here, up in the high single digits, double digits. And, business owners have to be educated, especially those smaller companies that there is a divergence here in pricing multiples. But what we see overall is a decline in those smaller deals, decline in the pricing multiples. Part of that is, what I said previously about some of the challenges in 23 as far as interest rates and fears of a recession and so on. So we're seeing more compression on these multiples, as well as more of these companies are add-ons. And so, as I mentioned earlier, platforms generally command a higher multiple. Add-ons are usually done at a lower multiple. So you're seeing that evidence here, and that compression here. Other deals, as you get larger, those multiples seem to be holding, and I would say in general, take these numbers, they move around a lot, and numbers that I've showed up here are from different data sources. And so overall, we look at these numbers and try to look for trends. And some of them don't necessarily always tie to each other. But overall, the M&A, middle market M&A space has been challenged in 23. Deal activity was down quite a bit. We are optimistic that 24 will be a significant turnaround. We talked about interest rates potentially coming down. I think everyone is expecting. We've seen the easing of inflation, and hopefully the Fed starts to pull back on its interest rates, and we'll see that trickle through to the credit markets. We had 23, if you remember in the early parts of 23, we had concerns about the banking industry itself with Silicon Valley and others. And so that had a ripple effect through the credit markets. We saw underwriting pulling back a bit. In 22, we saw longer underwriting times, more diligence from lenders. In 23, we actually saw lenders start to pull back in their deal activity. So we're optimistic in 24 that with the amount of capital that resides with private equity, with interest rates easing, with credit markets easing, and business owners, still we have this baby boom generation that's coming through that at some point will need to sell their companies. We think that 24 is going to be a much better year than what we saw in 23. So with that, we want to start taking some questions overall.
I'd be remiss if I didn't talk a little bit about insurance. So if you were to take some of the charts that we saw today, 2020, 21, 22 first half, and the big spike in volume, and then lay down a reps and warranties insurance rate chart over the top, you'd see the same spike. So going back to pre-COVID levels, we were at about 2.5% premium of the policy limit. And then going into 21 and first half of 22, we saw those rates go up to 4.5 to 5.5% in some cases. And then as the deal flow has decreased, the rates and the retentions have decreased as well. So just figured I'd throw that out. Also, similar, there was a chart that struck me about IPOs. From a D&O insurance standpoint, pre-COVID, we saw a record number of IPOs. What does that do? It's basic supply and demand, right? There's a lot more IPOs. Sometimes maybe those IPOs weren't as pie in the sky as people thought. Valuations of those companies drop significantly, and that generates lawsuits. Lawsuits basically generates a spike in premiums. So we went through one of the hardest public company and D&O markets, in the last decade, over the last few years, and we're starting to see that come down. We're also starting to see cyber insurance actually come in with some decreases for the first time in a long time. So anybody that purchases cyber insurance knows that there were a number of years where it was double or triple digit premium increases, and so we're starting to see that softening. So now that I can get off my insurance soapbox, we're going to open it up for questions. Brad has a microphone, and I see Eric in the middle already has a question. Eric?
Raise your hand, and I will bring you the mic. Or even better, stand up.
Thank you. Good panel, fantastic, appreciate it. Joe, appreciate it. As the market's pricing in the war in the Middle East, the tragedy that's happening there, right now seems like there's some panic in the marketplace behind the scenes, yet we're not seeing the numbers yet. Are you seeing something that you're not sharing yet today, or waiting to answer the question? People even on NPR were saying they're going to order every piece of inventory and get their hands on because of all the delays that are now coming up. Thank you.
So our economists, I was looking at this just last week. It's really hard to put a number on it. The analogy I'll use is the shipping challenges that we're seeing both through the Red Sea and through the Panama Canal because of the drought there. And if I remember right, it was going to be a 0.2% increase in inflation due to those two factors. So 20 basis points up on the inflation rate. And when we're trying to get it down, below 2.5% this year is where it looks like it's headed. 20 basis points is a lot. So that's what our economists are thinking on those two factors. The uncertainty around war is more difficult to quantify.
I have a question for Kurt.
Yeah.
So one of your slides you had up, there's optimism that rates are going to come down, but we also saw the spreads are compressed at the moment, right? So what are your thoughts about, as rates come down, will those spreads start to widen, so offsetting some of the decline in interest rates overall?
So we're not expecting that. They aren't generally linked. So the credit spread really is about credit quality and looking at the economy as a whole. So if there is optimism about the economy, and that's what that means when credit spreads are low, the hope and the expectation is that as interest rates go down, the credit spreads stay at their existing low rates. If all stays positive from a news perspective and an economy perspective.
We have a question back here.
Yeah, there's another question for Kurt. You mentioned the resurgence in equity-linked bonds.
Yeah.
Would you see that extending on the private market side to convertible debenture type deals with a coupon and a reduction in entry into equity?
So it's a little bit different calculus between a public convertible bond and a private convertible preferred. So with a public convertible bond, the valuation is more transparent and you can hedge it. So you can buy back your stock in the open market and take some actions to offset potential dilution. And so we find people making decisions on convertible bonds, evaluating that, okay, I made an acquisition. Do I finance it with bank debt or bonds or a convert? Oh, well, right now my stock price is really high and interest rates are pretty high, so I'll do a convert. It's a cost of capital decision or an access to capital decision. There are a lot of reasons why you do a public convert. It can be a smaller size than a high yield bond. In the private markets, that convertible preferred is much more expensive and illiquid, difficult to get rid of. And if you run into a hiccup in your business when that is coming due, it can turn into a loan-to-own scenario. So we find folks being much more careful with convertible preferreds, private convertible preferreds, because sometimes they can be a little bit like Hotel California. We find people do those when they have a real use of proceeds that is growth oriented, or they have no other option.
Will, question for you. You talked about the dry powder and the levels that they're at. Has Chartwell kind of peeled that back a little bit to say, first of all, is it correct to assume that if they're holding the money longer, there's more pressure to put it to work? And if that's true, have you analyzed kind of how that stacks in, of how much that money's been out there for a long time to appreciate that pressure point?
Yeah, that's a good question. Yeah, generally, those funds that are raised have a life or a timeline to get those funds deployed. We haven't specifically peeled that back to say X number of dollars need to be deployed next year, the following year, the following year. But in general, if you look at that trend with the continued increase in dry powder, we can assume that over the next few years, either that money has to be deployed or returned to the limited partners. So, we just basically assume that it's going to be a very, private equity is going to be very aggressive. And they have been and will continue to be. We are getting constantly pinged about our pipeline and any business owners in the room are likely getting calls on a weekly, if not more frequent basis. And, they're just very aggressively looking for transactions, both platform and add-ons.
What we have been finding with private equity is that they are, in the past couple of years, they've been more willing to put more equity in transactions to get something done, and then take a dividend out later to put capital to work. We've also seen private equity funds who typically do control transactions be more willing to do minority transactions or transactions with structure. And so if you remember on my private capital chart, only about half of it-ish was venture capital, like pre-IPO kind of transactions. The rest is kind of a proxy for private equity minority transactions. So there's been a big movement in towards that direction, that they've just tried to do something to put that capital to work. Yep. And a lot of them are out now raising funds again.
Yeah, yep. To your point, they're getting more creative.
Joe, Kurt, and Will, thank you so much for your remarks this morning. Questions probably more for Kurt. Kurt, you'd mentioned, of course, the SPAC market has basically evaporated. Can you comment a little bit about that? And Joe or Will, I'm not sure if you want to weigh in on that as well. Thank you.
So I will try to be balanced on the SPAC market as much as possible. So there were reasons why there were some innovations in the SPAC market that made it relatively attractive in the 19 to 21 time period. So you could, when you were out trying to get a transaction, well, first, for those that may not be familiar with the SPAC, I will step back for a second. What a SPAC is, it's another term for it is a blank check company. So what this is they go, a management team or an investor group goes to public investors and does an IPO and says, I want to raise money. I'm going to go buy a company. I don't know what company that is yet, but I'm going to buy a company. It's kind of going to look like this, and you're going to get to vote on whether you like that company. So this is an opportunity for public investors to invest behind a management team, kind of a proxy for private equity, where you can take a slice of a company and invest behind a management team. So one of the benefits and one of the reasons why someone might transact with a SPAC versus a private equity firm versus going actually public, is that SPACs could be smaller. You could do, it could be a smaller company effectively going public than if you were going a traditional IPO route. The other main reason is it was in a lot of cases earlier stage companies that it was all about the projections. It was all about what's on the come. And so it used to be in announcing the SPAC transaction where you announce a deal with the firm that is the sponsor of the SPAC, and then you have to go out and market that to investors to vote for the deal. When you're out there marketing to public investors, you could use projections. You could show projections, which you can't do in a traditional IPO. And so there were all these pie-in-the-sky projections being put out there. Some SPACs have really worked. There have been a few that have performed extraordinarily well. I work in the consumer and retail space, and so the ones that I'm familiar with are in that sector mostly. But if you look at Hostess, that was like a perfect example of a SPAC, an unloved company, big enough to go public in a SPAC, and then it was ultimately bought by Smucker. Great outcome for everyone involved. Utz Chips is another one that went public through a SPAC. That has been fantastic. But there have been a lot of these companies that had no business being public companies going public through the SPAC and this bubble and this excitement. And you would see as soon as a SPAC priced without any deal in place, it would trade up because there would be a lot of retail investors, Robinhood, just saying, oh, I want to invest in a SPAC. They always go up. So the SEC has been more circumspect about some of the rules around SPACs that has reduced some of the excitement around that and the projections and so forth. And SPACs make a lot of money for the sponsors. And so when people started doing some of the analysis, they would see there's a lot of value extracted by the sponsor in a lot of transactions. And so people have moved towards, okay, I'm just going to sell or I'm going to go public. So that market really has collapsed. It's always been a very specific market for a very specific type of company. It was used to a much greater extent than it should have been, and we're seeing it pull back quite substantially.
And I would add, I think that the, again, D&O insurance market saw the result of that. A lot of companies collapsing. I'm involved in a couple boards, and on one of them, there was an article that came out late December that said that the NASDAQ had 557 companies trading below $1, which is the floor for being NASDAQ eligible. So a lot of deficiency letters out there, and I think that was indicative to me that a lot of these companies came out a few years ago via the SPAC or reverse mergers or other, strategies that were really too small to be public companies. And so I think we're seeing that today in some of those news articles. So. Other questions? We got 5 more minutes. We got time for 1 or 2 more.
I just highlight on the M&A side, I don't know, Will, if you're seeing something different, but pipelines have been building for a couple years. We've been getting hired on a variety of assignments and telling clients to wait. In a lot of cases, there have been some situations where it made sense to go, and we've seen great outcomes with some of the deals last year and in 22, but there's a big pipeline of deals, and what I'm seeing in the pipeline that I'm looking at is folks trying to get their year-end numbers complete, get their quality of earnings done, and then get out in the market, try to get a deal done before the election. So what I would expect is those of you that are acquirers, you're going to start seeing a lot of books come across your desk in the next 2 months or so.
That's interesting. It seems like there's always got to be something that pushes the deal forward, right? And for Joe's a former tax guy, spent 10 years at Deloitte. It seemed like every year in December, that was the impetus, was because people were afraid of tax reform. So elections are something to think about.
Well, that's what we saw in That's what we saw in '21 with the administration change and the fear of tax cut, being rolled back. That was another driver in '21 of a lot of activity, and obviously that settled down when it became apparent there was no change in tax policy, that was being discussed. But you're exactly right. We have an election coming up, and pipelines. Our pipeline is about as full as it's ever been, and it is partly those business owners that have held off, hoping that interest rates are coming down and valuations will come back up. So, we're optimistic that '24 is going to be a very active year.
Question for maybe all of you. Large companies are arguably at the largest they've ever been in a lot of ways. Do you guys foresee any carve-out situations happening in mass?
Yeah, I mean, we're seeing, so in the sector that I spend a lot of time in is food. So as you think about big food companies being mix and matches of portfolios and moving around, I mean, the greatest example of that in the past year is Kellogg, just completely separating into 3 companies. We see a lot of that. So, there were a few carve-outs in the consumer sector last year, and we're expecting more as these, as you look at big companies who are really struggling for growth. We're seeing a lot of folks have been able to pass through price increases over the past couple of years, and volume didn't suffer. Well, in '23, we did see volumes decline in a lot of sectors where it was getting to the breaking point of demand. And so all big companies are looking at their portfolios and figuring out, okay, well, what can I do to improve my margin profile, improve my growth profile? And yes, acquisitions is part of that, but also separations. And we're having a lot of discussions around that now that the M&A market is coming back.
I like to put the deal story right in the middle. We need a little break up, put them right in the middle. It's always entertaining. High bar to reach after the last year's one, but I'm sure these guys are up for it, so we'll see. Tonka Bay partnered with CEO Jim Griffith to purchase Corporate Technologies in July of 2023. Corporate Technologies is a leading IT managed service provider, offering a full suite of IT solutions tailored to small businesses. These offerings include help desk support, cybersecurity, and cloud solutions. Corporate Technologies has 5 locations across the U.S., including its headquarters in Eden Prairie. I'd like to introduce Shane Slominski, Tonka Bay, who helped put the deal story together, and he can introduce the panel. But Shane, good to see you again. Thanks.
Thanks so much, Jay, and thanks everybody for being here today. We're excited to chat with you this morning. It's great to see so many familiar faces. And we're excited to tell a story today. This is a fresh deal that we just closed 6 months ago in partnership with Jim, who's sitting next to me, and we're very excited to talk about it. So we'll introduce ourselves briefly to get going, and we'll definitely leave time for questions at the end, but please feel free to ask questions along the way as well. Maybe to kick things off, does everybody want to just introduce themselves briefly? Jim, you want to go first?
Yeah, hi, Jim Griffith, CEO of Corporate Technologies.
Vince Sow, Associate, Tonka Bay Equity Partners.
Al Ampey, Board Member of Corporate Technologies.
And again, I'm Shane Slominski. I'm a partner at Tonka Bay Equity Partners. Okay, we got our slides up here. So just to set the stage, we thought we'd first just give a little bit of background on who we are at Tonka Bay. We're a local private equity firm based in Minnetonka. The firm was started in 1998, so we've been investing in smaller companies for over 25 years now. Our tagline is building bigger, better businesses. Our strategy in a nutshell is investing in entrepreneur-owned businesses. So we're looking for really good businesses that are privately owned, that have a lot of runway, that are looking for a capital partner. Over the course of 25 years, we've invested in 43 partner companies. We call our companies partner companies because we really do view it as a partnership, and over 80 add-on acquisitions. So sort of the last slide of the previous panel talked a lot about add-ons, and we'll talk more about that today. We do like the Midwest, so we're based here. If we could do every deal in Minnesota, we would. That's not realistic, so we invest all over the country. But about a third of our partner companies have been based in Minnesota. The size is 3 to 10 million of EBITDA. We define that as the lower middle market. And again, companies that are profitable and growing and are almost always owned by an entrepreneur. And our strategy is to help those businesses scale to the next level. The sectors are business services, manufacturing, and distribution. And we work with these companies from the board level. So we're not operators. We work with great management teams, which we'll talk more about today. The ways we try to add value beyond just bringing capital to these businesses is by working with the management team to develop a strategic plan. And we'll talk more about corporate technologies today specifically, but our strategy is to develop a network of resources that we can complement the management team as they're executing a growth strategy. These resources could be board members, as we'll talk about today, or external resources that can help to facilitate growth. We have what we would call more of a patient approach to create value, given that we're investing in entrepreneur-owned businesses. There's many times some professionalization that's needed, building of the management team, and other initiatives that are needed prior to being in a position to accelerate growth. And then building a network of operating partners is a big part of our strategy. So we have a network of over a dozen operating partners that we work with that sit on the boards of our companies and work very closely with our CEOs to generate growth strategies. So with that, I thought we would start by talking a little bit about our strategy to invest in this industry that corporate technologies participates in. Vince, maybe I'll start with you. Do you want to talk a little bit about how we got interested in this space?
Yeah, absolutely. So prior to corporate technologies, Tonka Bay made some runs at IT service companies for the past couple of years, and throughout that process and through our due diligence, we kind of learned a lot about how large an addressable market was and how highly fragmented it was across the country. So the industry really spoke to us from that standpoint, and then as we learned a lot about the business model of an IT managed service provider, the recurring revenue, the value proposition it provides to business owners, especially in the cybersecurity offerings, and then kind of the cross-sell opportunities of services you can provide. I think those three tenets really made us really excited about the opportunity. So what we kind of did here at Tonka Bay was came up with an IT service-focused industry where we said, let's go find to partner with the company that has these tenets, and ultimately created this target profile that corporate technologies eventually fell into. So subsequently, this target profile that Shane has up on here, we kind of said within our $3 to $10 million of EBITDA, let's partner with someone on the lower end. And from there, we kind of work with the CEO to blow out that organic and inorganic growth strategy together. We really focus on the MRR, monthly recurring revenue, which really says, within your revenue streams, is it recurring or is it a hardware reseller? And we wanted to focus on something that was on the up and up of kind of not necessarily 20% recurring, but more on the 50%. So we kind of blow that out to more than 80%. So really with all of these kind of different tenants, we really got excited when corporate technologies came around, and it matched our profile to a T.
So maybe just take one step back. Jim, not to put you on the spot, but this MRR, so we say here MRR 50% sweet spot. Do you just want to define what MRR is and why that percentage is important?
Yeah, so MRR stands for monthly recurring revenue, and in our business, that's the contractual amount that the customer has agreed to pay us on a monthly basis. And depending on the industry, that can be a contract base or it can be month to month. And so with managed service providers, with IT services providers, it's generally anywhere from 1 to 3 years, although there are companies out there that do it on a monthly basis. And why it's so important is obviously it's the consistent cash flow and making sure that those customers are paying that service on a monthly basis and delivering is what's most important to these businesses. And you'll see it later on the slide, there's anywhere from 10 to 40,000 MSPs in the country, depending on how they're counted. But there are a large portion of them that just have 10 to 15% of their revenue coming from recurring revenue. And matter of fact, Corporate Technologies at one point had virtually no recurring revenue. So kind of finding that right revenue profile is always important because that's where we believe the most valuation is for the next buyer.
And sorry, just one more definition, so we make sure we're outlining it. MSP?
Yeah, managed service provider. It's a term that's used in a bunch of different industries as well, but for us, that managed services, and that's always defined differently depending on the company, but for Corporate Technologies, it includes remote monitoring and maintenance services. So for all your computers, they need to be maintained. And just like your car, when your check engine light comes on or your need fuel light comes on, that's a monitoring event that my company will continue to evaluate and see if something needs to be done. It includes help desk services. So, when you can't print or can't send an email, you would call our company and we would take care of that problem for you. It includes field services. So if we can't fix something remotely and we need to dispatch somebody, we've got technicians in all of our markets, and then project services as well. So that's what our definition of the managed services are.
So Vince mentioned that we had been working on a strategy for a while at Tonka Bay, and for about 18 months, we had crafted this thesis, been proactively looking, trying to find an MSP to partner with. And we looked at probably 24. We spent a lot of time on 5 or 6, and many of the ones that we looked at that weren't a good fit, had MRR that was below that 50% threshold. Other ones, some of the reasons we didn't pursue them were they were small companies that had been cobbled together, but they weren't really a business. It was sort of, early innings of integration, and so there was a lot of hair on the business yet. So we were, for 18 months, we continued to look. And maybe to transition then to Corporate Technologies, Jim, do you want to tell us a little bit about Corporate Technologies?
Sure. The business was started in 1981 in Fargo, North Dakota as a Computerland franchise, which most of you won't even remember. I didn't either, so. But in 2005, it was purchased by a company called North Central Equities, which I was a partner in, and their business model at the time was buying broken businesses and turning them around. And so in 2006, I had just returned from Europe. I used to run phone companies over in Europe, and when I came back, I was given the directive of fix this business up and put in place a growth strategy. And so in 2006, managed services was the buzzwords that were entering the IT space, right? And so this business at the time was what was called a VAR, what's still called VAR, which stands for Value Added Reseller. And these are companies that sell computer, like Dell and HP. They don't sell directly to small businesses, medium-sized businesses, and even enterprise accounts. They always work through partner companies, which Corporate Technologies was at the time. And it was around a $20 million business, 19 million in revenue, or 19 million in product revenue, another million in services, and all those services were project services. And so losing money, product margins used to have 35–40%, and as some of the companies went direct, like Dell, product margins declined. Businesses like Corporate Technologies didn't adjust their operating expenses with the new margin profile of the product that they were selling, and so we went in there, bought the business, and so my job was to put in place a new growth strategy. And so having run phone companies, which we were putting packages of services together there, it was 500 minutes for 50 euros, depending on the market. Created that same type of service offering with these IT services. And so that's how we came up with the remote monitoring and maintenance, help desk, and field services, all for one monthly price, right? And we packaged it based upon desktops and servers, right? So depending on how many servers and desktops a business had, you paid on a a monthly price for each one of those. And we ended up doing several other acquisitions of, again, broken IT businesses, and every business we bought, we would support whatever legacy business they had in place, but when it came to growth or new business, we were going to focus on managed services. And more specifically, the companies that we were buying were, their customers were middle market businesses, right? And I did not want those as my customers because I saw what they did to these businesses. And those businesses generally have departments designed to beat up businesses, procurement departments that are going to have RFPs that's going to drive down the profitability of any product or service that you're delivering them. And so I purposely wanted to focus on the small, medium-sized business and really the S of the SMB. Because I'm a firm believer that that's the lifeblood of our economy, right? The Targets of the world, the 3Ms, at one point they had 10, 15, 50 employees as well. And I look at technology services as the real differentiator to becoming a larger business, right? The first panel this morning was all about private equity, and I think our capital markets in this country are very well organized so that if you've got a good business idea, you should be able to find a capital partner to help you grow at whatever stage you're at, right? And so I think the real differentiator between businesses that are going to grow in the future is actually their technology services provider, right? And so I wanted to create Corporate Technologies as a business that could provide IT services to the small businesses, right? And so over time we transitioned this business into the majority of its revenue and gross profit coming from managed services. We did these other acquisitions. We did a buy versus build, and so we started an office in San Diego, but we bought companies in Boise, Grand Rapids. I bought 2 businesses in Grand Rapids, Michigan, small publicly traded company in New Jersey, and that was how we built Corporate Technologies initially. And so, but always continued on focusing on growing the business with small businesses for managed service contracts. So.
Great, thank you. And then maybe fast forward to 2022. So you were looking for a partner. Maybe tell us about that and talk about what you were looking for in a partner.
Yeah, so I actually met with Tonka Bay in 2009 in order to buy the Corporate Technologies. And at the time, managed services and this type of business model wasn't as popular as it is today. And the profile, the revenue profile was not the same as it is today, but always had this vision of creating a national managed service provider. And in 2022, I knew that North Central Equities was looking to sell the business because I was a partner in it and I've got a long history with the CEO of that business. And so I started looking at putting together a list of private equity companies that could fund the deal. And matter of fact, I met Al in 2006. I called him up, and he had known about Corporate Technologies and the business I had been running, and he said, "Do you have a book?" And I said, "No, I don't have a book." And so I ended up putting together a SIM and getting that over to Al, and Al was very well connected because he had ran a private equity-backed business as well, and he had relationships with North Star Financial, and he ended up introducing me to Tonka Bay. And so North Star works a lot with Tonka Bay, but what I was looking for in a partner was obviously somebody with a commitment to this business model, right? In 2018, I left Corporate Technologies to do another roll-up and did 16 acquisitions, but the person that I was working for ran out of money. And so for me, it was making sure that I had the right financial partner that was not only committed to this business, and really the business meaning focus on the SMB customer base, but also had the financial wherewithal and the financial commitment to continue to allow me to continue to pursue growth through acquisitions as well as organically.
So I still remember our first call. We got connected and we had a phone call. It was the week before Christmas and New Year's of 2022. And we had been introduced, but I didn't know a whole lot about the situation. And you were describing what you were trying to do. And we had been working for 18 months trying to find a business that looked exactly like what you were trying to do. I mean, it was just crazy how much the two different strategies fit. And that sort of led to a lot more conversations, which we'll get to. But I don't want to gloss over Al. So, Al, we didn't really go through your background. Jim alluded to it. Would you mind just giving a little bit more about your background and then kind of how you got introduced to this corporate technologies transaction?
Sure. I was a founder and CEO of IT services business based in Minneapolis called Comworks. Our focus actually was completely opposite of Jim's. Ours was more Fortune 1000 type businesses. We did the IT services for the branch locations of the Fortune 1000 companies all over the globe. So our biggest customers were JP Morgan Chase and Apple and Tesla, and our focus specifically was on all their infrastructure. We are actually a customer of corporate technologies because I bought product from them in areas, which was ironic, up in North Dakota. But I was introduced to Jim a number of years ago. We just met at a golf course, I think, more than 20 years ago. And we've been keeping in touch for many years. And when he came back and he was looking for a financial partner, you know, it's, as Jim mentioned, I recommended get a sim together, and I shared it with Brian Schneider over at North Star. And ironically, comes back, it's not so ironic that it comes back with Tonka Bay is one of the highest on their list, and it correlated with Jim's recommendations as well. And my recommendation, because I had some private equity partners, and that's a whole nother story that for a lot different panel, was to make sure you got a good partner. Being local was certainly a plus for him, but a good local partner with a great reputation, and really what you're looking for is a thoughtful partner that's going to make sure that you can help grow your business and they can give some insight. And you know, the way I got introduced through Jim and the team, I was really impressed because Tonka Bay makes sure that they put people on their board that have had previous experience and some knowledge that can really be a partner for the business and the CEO.
Yeah, so it was a coup for us to meet Al. We didn't know Al previously. We were aware of Comworks. It was a great local story. But when we were working on the deal with Jim, we met Al and thought he'd be a great board member because that's a big part of our strategy. And we'll talk a little bit about more about that in a minute. Okay, so Jim, that's a little bit about the background. So we still had to put a deal together, though. So we have this slide that just goes through the timeline a little bit. I mean, priority one was getting an LOI signed. So you had an inside track because you knew the owner of corporate technologies. But how do we go about that? What were some of the challenges of getting an LOI signed?
Because I did have an inside track, I knew what the valuation was. I knew exactly what kind of terms that he was looking for. And so for me, I had to play both sides of the fence. And I mean, the real challenge was the former owner believed that there was some upside in the business, meaning 2023 valuation or earnings was going to be better than 2022. And so part of what working with Tonka Bay, who I found to be extremely flexible in putting a transaction together, was putting an earn-out into the deal, which we're still under, and we'll have it done by the end of June of 2024. But you know, that was probably one of the bigger challenges is making sure that the former owner was comfortable so that if there was some upside, he got to participate in that as well. So
yeah, I think that's right. I mean, I think his initial inclination was to wait because the earnings was a little bit of a hockey stick, and he thought at the end of 23 the value was going to go up from where it was in December or January of 23. And we didn't want to wait because, you know, our philosophy was nothing good comes from waiting. And so we tried to think, you know, creatively with Jim about a structure. And generally we hate earnouts because they're just ripe for disagreement. Disagreement in how you structure it, disagreement in how you measure it after the fact, who's calling the shots in between. So they're ripe for disagreement, but in this situation, it was a good tool to be able to bridge that gap and, more importantly, accelerate the timing to not have to wait till the end of the year. Okay. Vince, what were some of the other challenges we encountered during the due diligence process?
Yeah, so as we learned a lot more about the IT MSP space, retention was something that we were keenly interested in, and customer churn analysis is, you know, as we learned about the IT MSP, like, you're naturally going to lose customers, and that's something that we had to get comfort over of, you know, I understand that corporate technologies may lose one customer this month, but how do we backfill that and grow on top of that? So that was something that we had discussed many times with Jim and ultimately got comfortable over kind of the sales engine that Jim had built up at corporate technologies. But alongside of that was kind of customer feedback that we would kind of do as well. And, you know, unfortunately in this industry, no one really speaks highly of their IT MSP provider. I think the bar is kind of, you do your work and it's great, but if something goes wrong, Jim's the worst person in the world. So, you know, we had to take that with a grain of salt as we read the customer feedback, but ultimately, I mean, we all talked internally and said, you know, Shane, do you speak highly of our IT MSP? And it was kind of like, I don't know what I'd rate them out of 10, so.
Yeah, I mean, just maybe to put a point on that, we always do a market study when we do a new deal like this, and the firm that we used, they said, like, they have done a ton of projects in the IT services and the MSP space. And they said, I mean, you have to lower your expectations for what customer feedback's going to be compared to buying a manufacturing company or something like that, because it's almost like an offensive line. Either, you know, people don't say anything, or they're going to complain if something's going wrong. So it's really hard to get high marks when you're doing research on an IT services firm. And case in point at Tonka Bay, I mean, we would do the same thing. We would say, you know, things are fine, but you're not going to give glowing remarks. And, you know, if something bad happened in the last week, you might give a bad review. Jim, any other comments on that? Because this customer churn thing is kind of a big deal in this industry, and it's something it's a part of the business.
Yeah. One, because of our customer base, right? The S of the SMB, you're just going to have higher attrition. But one of the things that I learned when I was running phone companies in Europe is, you know, you need to measure the customer churn in order to calculate how much you can spend for customer acquisition. And so part of our model, we always understood that as long as the churn allowed you to have a return on your investment of the customer acquisition cost, it was appropriate. Now, that does not mean that we did not care about service, and we continue to care about service. And it is a tough industry where, you know, everybody thinks they know how long it should take to fix something, right? And I don't know if you guys have heard of Murdoch conversion vans, right? They were a customer. I think they still are a customer, but I remember one time talking to the owner of that company, and he didn't think it should have taken 8 hours, and it got escalated to me, and he didn't think it should have taken 8 hours to install 2 new desktops at his company. And I said, how long does it take to convert a van? These guys do these custom vans, and he said, I don't know, he said like 120 hours, right? And I said, I only think it should take 60. Right? And he finally got the point. Like, I had no idea. I should not be making recommendations as to how long it takes to convert a van. You probably shouldn't be making recommendations on how long it takes to set up 2 new desktops, because it's not like just loading another song on your iPod. And but it's, you know, customer churn is extremely important because it tells you on average how long the customer life is going to be. Right? And so if you have 2% monthly attrition, that means on average your customer is going to last 50 months. And so we're constantly looking, and our churn is much lower than that, but just to kind of quantify why churn is so important. And it's something that we look at all the time because we know how much we pay to put on a customer, right? And our business, because the costs are front loaded, right? I've got 25 to 30 salespeople in our 5 markets, and so I'm spending quite a bit in January of 2024 to bring on customers that are gonna have revenue and gross profit that month that will not equate to how much I spent in sales costs. And so I've got to know that, that customer is gonna last on average 78 months. It's gonna take me 14 months to pay back the customer, and then I've got another 50, what would that be? 58 months of return on investment. So churn is extremely important in our business.
It's a natural part of the business, and so that was something we had to get our head around in due diligence, because just using round numbers, if churn is 1% a month, that's 12% a year. And most businesses we invest in aren't losing 12% of their customers per year. That sounds bad, but in this business, stuff happens for the reasons we talked about. And so the strategy needs to be, you need to be adding more customers than that to be growing.
Yep.
Vince, any other lessons learned you want to touch on?
Yeah, so I'd say post-close, I think one of the things that we really honed in on was kind of data integrity. As we kind of worked through these customer churn analysis, it required a lot of data from corporate technology CRM just to really understand when the customer was brought on, when the customer rolled off, kind of what happened in between those months. So, luckily Jim and his team were able to provide us the detail we were able to kind of spin through and kind of find that. So I'd say data integrity is something that's really important. Which kind of goes along the lines of setting up your company for sale and being organized from a documentation purposes of where contracts are loaded or where contracts are. So yeah, I think those are just simple 2 things that we thought were important to kind of highlight.
Yeah, and that's really the case with any entrepreneur-owned business, that there's a lot of that has to happen. The other nuance with the corporate technology story is they were owned by this holding company, North Central Equity, so they were on some shared benefit plans and things like that, insurance policies. So there was some additional work needed to establish some new benefit plans as a standalone business. So that required a little bit of nuance. But we did, as mentioned, we closed in July. And so, it was kind of a 6 or 7 month process from when we first met Jim, got in front of the owner in February, got an LOI signed. We were supposed to close June 30th. Jim was sort of sour that we didn't close on the 30th. It wasn't because of anybody at this table, but we ended up closing on July 12th. So just shortly after the end of the second quarter. Okay, so Al, so you were you ran a business. You're a founder. You ran your business. You worked with private equity. You've had multiple successful exits. I know this is fresh because we're just 6 months in and we're just getting to know each other. But can you talk a little bit about the role that you envision playing with corporate technologies and Jim?
Sure. As I mentioned, Jim and I go way back, but what I'd really like to be is a sounding board for Jim, somebody that he can lean on a little bit. When you're the decision maker and you're the CEO, there's very few people you can kind of lean on once in a while. And if he can come to me with questions, concerns, ideas that I can help him vet, I'd really like to help him avoid some of the pitfalls and distractions and the mistakes I made over the course of 27, 30 years. And if he can do that, if I can add that sort of value, I think there's a lot of value he can gain from using me for those sort of things. I think that one of the biggest opportunities for Jim is going to be recognizing that now he's a $50 million business and he wants to be a $100 million business, that he can't do all the same things when he's $100 million as he's doing now at $50 million. Kind of got his fingers and hands and everything. So he's going to have to professionalize his management team. He's going to have to start relying on people for things that he didn't know he could really trust and rely on them for. And I think he's going to learn that over time. And if I can help him do that and help him find some of those people, and as I mentioned, avoid some of those pitfalls, I think there's some real value there, and I'm really excited for the opportunity for him.
Yeah, no, it's been fun to have Al on my board, as well as the guys from Tonka Bay. And I would call corporate technologies a big, small company, right? And I always knew that, but always wanted to grow something bigger. And I recognize that I don't know what I don't know. Right? And, by bringing in people like Shane and Al, like I get to learn things that I would never have been able to learn on my own. And so there's real value with a partner like Tonka and a board member like Al in order for me to grow the business, right? I know what I would like to build. I know what I think that we are capable of. But there's just so many things that, you know, because I don't have the experience of 43 platform companies and, you know, 3 private equity firms, and, you know, Al grew a very large business, you know, it helps me to fast forward the vision that we have for corporate technologies.
Great. Okay, so we closed the deal July 12th. Vince, what are some of the things that we typically do right after we close with the CEO?
Yeah, so the first part's really been talked about. It was really building out that board, and that really starts pre-close. So working with our operating partners and understanding the industry and the company itself, and then having them on our board, and then finding Al and partnering with Al to help Jim and Tonka Bay really narrow in on that strategic planning, which may include additions to the management team, understanding where allocations need to be made from an investment standpoint, from an organic strategy, and then from an inorganic standpoint, you know, what are the synergies? What does this look like post-close? What is this like from the exit strategy? So I'd say the big 3 tenets are building the board, building out the management team, and helping out Jim flush out his strategic planning.
Great. And then Jim, we did a strategy session right after we closed last fall with the board and you and Tonka Bay. Do you want to kind of outline what the takeaways were from that strategy session?
Sure. Obviously, we continue with organic growth, and that's, you know, in the MSP space, there's a lot of great technology service providers, but they don't have the growth engine that corporate technologies does. And so we'll continue to execute on our organic plan of adding on new customers, but also adding on new services. And so at the end of 2021, we launched a new cybersecurity service offering. We've been around 35-40% of the customer base has adopted that, and so we'll continue to push that into the customer base. But we're also going to look through for other acquisitions. So when I left Corporate Technologies, I did do 16 acquisitions at another business, and so there is a lot of opportunity out there to buy other businesses, and we'll talk about that in a little bit. But we've already completed our first acquisition, and we'll continue to probably add on at least another 1 to 2 businesses a year for the next 3 to 4 years.
Good tease. Al or Vince, you guys participated in the strategy session. Any other takeaways from your perspective?
Well, I think that one of the biggest focuses was acquisitions, but you'd already completed that, so we'll talk about that, which is ironic. But the real opportunity is the similarities that in the business I was running and what Jim's got, and that's a lot of inside sales, cold calling, those sort of lead generation programs. And I think that some of the emphasis for his organic growth can be through technology and improvements in the sales cycle and close rates, et cetera, by generating warm leads through all the different technologies that are out there now, whether it's SEO or target markets or buying behaviors and those sort of things. And that was had a dramatic impact on my business, and it'll have a dramatic impact on his sales force as well, because there's not a salesperson around that loves doing nothing but pound the phone and get voicemails and never get any connection. So if you can get warm leads and close these leads, and I think the effectiveness of his sales force will allow him to grow dramatically organically. And if we can focus on those through our strategy sessions, I think it'll be a big win.
Yeah, and then I'd say the other thing that we talked about was kind of customer service and the customer service delivery model. Jim came in day one and made operational improvements to kind of the help desk, and what he really did was hired a service help desk manager to really oversee the operations and then really decrease wait times for customers. I think it's a dramatic effect when you call corporate technologies and they pick up in 3 seconds versus 3 minutes. So those improvements were seen on day one. So we kind of talked about what other ways that we could kind of improve that from to increase customer satisfaction.
So what's happened to customer satisfaction since we closed 6 months ago?
So we measure CSAT through a program called SmileBack, but it's increased from 92.5, which is very good, to 96.5. And so just so everybody understands when it comes to response rate, so when you call corporate technologies, we actually have technicians pick up the phone to start resolving your problems. And so this is going to be a little pitch, right? Because a lot of MSPs have what's called a response rate, right? And response rate just means that we acknowledge you called, we acknowledge you have a problem, and I never liked that model. And so we have a technician that actually is the one that says, thank you for calling corporate technologies, how can I help you? But that same person can also resolve that issue that you have. And so but no, the customer sats have gone up, and attrition actually has gone down as a result of that, because 70% of the issues that a business has are kind of tier one help desk issues, and so by being able to get that person on the phone to resolve your issues more quickly is more important, right? Or is the most important.
Great. So Jim, you alluded to acquisitions. What are we looking for in acquisitions?
So for add-ons, probably at least 500,000 of EBITDA. That's even on the low side, probably closer to $1 million. We're still looking for 50% or more from recurring revenue. New markets. My experience with acquisitions on taking two competing companies in the same market and putting them together, those have always been my more problematic integrations, just because they were competing businesses, they used to talk poorly about that person as a competitor, and now trying to put them together, I didn't have as much success with that. So new markets is where we'll be focused on, I think on the low side we could get down to $500,000 in EBITDA, but it would be there's enough out there at $1 million plus as well. And so obviously the valuation comes down a little bit as you lower the needle, but we still think there's opportunities at the $1 million mark too.
And we would do bigger ones too.
We did.
Well, okay, we're gonna get there. So talk about you referenced it, but we already closed a deal. You want to talk about new MSP?
Yeah, so I ran a company called New MSP. I was hired to do a roll up there. This is the group that ran out of money midstream, and so shortly after closing on corporate technologies, I'm sitting in the Uber on my way to our office in New Jersey, and I get a call from my former VP of sales who still works at the business, and he says they're laying me off, and turns out they had run out of money again. And so I called the CEO of that business and asked him if he was interested in selling, and sure enough he was. And so on December 29th, we closed on the company that I used to run, and so that added 11 new markets.
I thought Corporate Technologies was the company you used to run.
It was, yeah. So there's a little bit of a pattern here. Tonka Bay provides me with money to buy all the companies I used to run, and so there's two other ones. So. But yeah, no, it's a very exciting acquisition for us. It gives us 11 new markets, and I don't know if they've got the new slide in the background, but the goal of being a national MSP is it became more of a reality with this acquisition, and it really puts us. Financially, it puts us about 2 years ahead of schedule. I know that Shane and the rest of the board aren't going to let me kind of rest on my laurels. It just means that the plans for 4 or 5 years out just got larger, and but this really fast-forwarded our business plan and allowed us to get into 11 new markets, over 400 new customers, and so fantastic. And going back to the private equity group this morning, we were able to buy this at a lower multiple than we were for the platform, and so obviously part of our model is EBITDA arbitrage, and so if we're able to reduce the overall EBITDA margin or the EBITDA multiple for the businesses as a whole, it'll help us during the exit. So,
how are you going to integrate the acquisition?
So we're working on that right now. Matter of fact, the new MSP management team is flying into town this week, but we'll spend 2024 doing that. There's their service delivery is very similar to the one at Corporate Technologies, and that's probably not a coinky-dink. It's because I ran the other one too, but they have centralized help desk. They have regional help desks, right? Whereas Corporate Technologies has it just in Minneapolis. We provide those services to all 5 of our markets. So as far as kind of an integration, this was a perfect match as far as the service delivery profile of new MSP and Corporate Technologies. But yeah, we're kind of 1 month into our 90-day integration plan, and so far so good.
Great. So what does the future look like? You mentioned not resting on your laurels. What's coming down the pike for you and Corporate Technologies?
So 2024 is going to be about the integration of new MSP, and then and focusing on new business development. As Al mentioned, we've been highly successful with a pretty punch you in the nose kind of sales strategy, right? Cold calling, anybody that says cold calling is dead, you just haven't picked up the phone, because we're wildly successful. But I learned a lot about lead gen when I left Corporate Technologies, and agree with Al that that will help me to scale the business much more quickly, because right now, in order for me to kind of double the sales, I need to kind of double the sales force. And so if I can focus on lead generation and technology with marketing, I can have those leads come in on a daily basis and feed my sales team. And now all I'd have to do is turn up the dial on the marketing spend instead of hiring another 10 or 15 salespeople. So 2024 is all about organic growth and then integrating new MSP.
Great. Well, I think that wraps up our prepared questions. Happy to open it up to any questions from the audience. I think there's one we've got one right here. Okay.
Really appreciate your commentary on how you're doing the organic growth. One of the questions that we've been trying to identify is, as we're growing and adding new staff members to teams, you're going through a phenomenal way of going about growing your teams. How are you integrating the different cultures to kind of take that approach of your sales tactic, so you're not just picking up the phone and responding, you're having the actual technicians responding on the calls? How are you going about integrating the different cultural aspects of the different businesses that you're acquiring?
And that's a great question, because some of the businesses that I acquired when I was at new MSP had different models, right? But fortunately for new MSP, they had the same model as we do at Corporate Technologies. But when we go and do new acquisitions, I will spend a lot of time on making sure that there is a cultural fit on the service delivery. And if it's not a match, then I don't think it would be an acquisition that we would pursue, even if it worked financially, because there are many different ways to deliver IT services. And we've been highly successful at Corporate Technologies, but there's other businesses that have been wildly successful and have completely different business models. And so and even though I may be the acquirer, you don't want to go in there and say, hey, Don, you should be running your business this way. And so unless there's agreement on kind of how we should deliver the services, it's probably not going to be a business that we would acquire. Yep.
Thank you, panel. Jim, it's a pleasure to meet again, this time in person.
Yep.
Corp Tech's phenomenal, fantastic. If you can do a deal with them, do it. I wish we could have gotten married, with a client of mine, a managed service company, but we didn't quite make it to the altar. In-laws were always fighting. It's how it works. My hair's gray from that. It was black before. But, Elam was hard to, he's a great negotiator, phenomenal.
Yep.
But now really, do we have to have shared revenue with the sellers of all these businesses in order to make a deal, get over the threshold? Because that's really where we hung up on the deal, was what does it look like post-sale? And what does the share look like? What kind of revenue metrics would you use? Thank you.
Just, can you repeat the question?
I packed a lot in there, sorry. But, you know, I mean, the revenue share seems to be the issue with sellers today.
Yep.
They want the upside. They
Yep.
don't want to just sit there and take a final deal, maybe a seller financing package, but they want to have share in potential upside, maybe with their current contracts on the monthly revenue or some quarterly metric, annual, whatever it may be.
Yeah, and you know, our earnout is only measured 12 months after close, but it was great working with Tonka because they were very flexible on crafting language in the purchase agreement that the seller, you know, Elam could get comfortable with. And obviously, you know, putting some circles around operating expenses and kind of the most that could be allocated back to the operating company was extremely important for the seller, for Elam. And so, you know, it really depends on you know, the financial partner. And maybe Shane, you want to kind of talk about that.
Yeah, and maybe not specific to this deal, but I think maybe a couple comments just on when there is maybe a valuation gap, or you think the business owner thinks the value is going to continue to increase. And we chatted about it earlier, but with this deal, you know, that's exactly what was going to happen. The value was going to continue to go up over the next 12 months, and we didn't want to wait. We wanted to make something happen, and so we tried to use this earnout as a bridge to have a meeting of the minds to do a deal today. You know, the other tool that we use, and most private equity firms do, with an entrepreneur seller that thinks the value is going to continue to increase, is rollover equity. So that's sort of a way to have a liquidity event today. So, you know, take your chips off the table, you know, today and not take the risk of what could happen going forward. But if you think the value is going to continue to go up, you can own a piece of that. And admittedly, it's a smaller piece, but hopefully a smaller piece of a bigger pie. And so those are kind of two different tools. The earnout, which, as I mentioned earlier, we don't like, but can be a tool, and then rollover equity to create alignment if everybody thinks the value is going to increase over the course of time.
Good morning. Thanks, panel. Josh Bouchard from Grant Thornton. Shane, this is a question for you. It's really a governance question. We work with a lot of private equity-backed companies, and not very many of them put outside directors on the board. It's often just folks from the private equity firm. Tell us a little bit more about how you think about outside directors at your partner companies. Are there multiple? You know, how do you scale that? What sort of value are you? We heard a little bit about some of the value you're looking to get out of Al in this process, but how does that evolve across your portfolio?
Yeah, good question. Thanks, Josh. Yeah, these board members are a very important part of our strategy. So every company we have at least one or two and not more than three outside directors. And we think it's really important for the CEO to have board members that they can call outside of board meetings. Obviously, we're all in the room together, but it's really important for the CEO to have board members that they can call outside of the board meeting to pick their brains. Because while we sit on a bunch of boards at Tonka Bay, we're not operators. And Al is an operator. And so he's been in Jim's chair, and that's a different conversation for Jim to have with Al than it is that conversation that Jim would have with me. And so we think it's super important. One of our longtime operating partners also described it as that role can be a little bit of a translator. I'd like to think we're pretty transparent at Tonka Bay, and we always try to be, but sometimes things may get lost in translation. We may be saying one thing, and the CEO is hearing something else, and somebody like Al or an outside board member can help be that in-between to help say, okay, I know you think you heard this, but this is really what, you know, Tonka Bay is driving towards. Also, these board members can be a plethora of resources. So part of our philosophy at Tonka Bay is let's bring external resources to help the CEO to execute the strategy. And I can't tell you, I mean, it's been 6 months, but Al has already made numerous introductions to Jim and to Tonka Bay that, you know, we're all in town here, and, you know, people that we didn't know that have been really helpful. Our other board member right now at Corporate Technologies is more of a functional expert. So we have two outside board members. It's Al well. And then we have a technology expert who's on a couple other Tonka Bay boards that are more tech-enabled services. And so, sometimes it's bringing that functional expertise. Other times it's, former CEOs. So it's a really important part of our strategy. And, I think it's really meant to be. Maybe one last thing I'll say is we have had CEOs, not Jim, but we've had other CEOs that have been skeptical about these board members. Like they're maybe looking to take their job, or they could be a threat. And the type of operating partners and board members that we align ourselves with, don't come across that way, but still we sometimes get that question. And I know that's not Al's goal here, that he's not looking for a day job, but it's a nice way to continue to stay engaged and leverage all of his past successes. And we try to do things like Al, Jim, and I get together for dinner every month. This is not the board meeting. This is sort of the meeting outside the meeting to talk about, what things is Jim dealing with on a day-to-day basis. And then hopefully that spurs conversations just between the two of them that I'm not a part of.
Yeah, I think that says a lot about Tonka Bay, because you're right, there are a lot of PE firms that will just stack the board. But really what Tonka Bay is looking for is the success of their partner companies. And so, it's very thoughtful the way that they will add outside directors onto my board, as well as the other businesses that they've invested in. So,
From a business structure standpoint, it sounded like putting a shared services team was a part of the original plan for growth.
No.
I saw somewhere shared services.
Shared
building
services
in.
was the former owners.
Prior to the deal.
Yeah, they had legal services and HR and benefits as shared services through other companies that they owned.
As you scale, are you going to have to kind of pull a lot of that together as you start buying up additional companies?
So we'll add on those people to our business. So we're looking for a new CFO right now. We'll add on a director of HR and a director of IT, and so some of those services would have been shared before, and we'll bring them on to corporate technologies directly.
Let me know if you need any help there.
Okay. So that wasn't a question. That was, in sales, that's what we call discovery.
Well, we'll just start on the end. Joel, you want to give a couple minutes about yourself? And
yeah, of course. Good morning, everyone. My name is Joel Grebnick. I'm one of the partners at a firm in Minneapolis called Northern Lakes Capital. We're a small group of a newer fund. We were actually formed in 2021, and we're investing out of our first fund, which is a $210 million committed capital fund, and we can get into that a little bit later, what that means. We have two fairly distinct investment strategies. One is we do a lot of investing in the kind of the core Midwest, upper Midwest area, all family founder-owned businesses. And the other part of our investment strategy that we spend a lot of time on is we do more dedicated industry buy and builds. So we'll go create a thesis in a space and go outbound and go try to find anywhere between 8 to 10 best-in-class businesses across the U.S. to acquire under more of a holding company structure. There is 11 team members at Northern Lakes, and we're based in downtown Minneapolis. So thanks for having me here, and look forward to the panel.
Well, hello everyone. I'm Seema Griffith. I'm a founder and managing principal of Athlon Capital. We specialize in selling privately held, mostly family, entrepreneur-led businesses that have between 20 million and 200 million in revenues. 3 industries, a lot of manufacturing companies, technology, consumer products, and transportation and logistics. And athlon is the Greek word for prize of the contest, as in decathlon or triathlon. And our mission at Athlon is to get business owners that prize or that big paycheck at the end of their entrepreneurial journey from people like you, Joel. And on the personal front, I come from a family of entrepreneurs. The family owned a tennis club, which my brother and I worked at in high school and college, and that's how I ended up in finance. It was the guys at the tennis club who said, go into finance, that's where the action is. And so here I am 25 plus years later, and I have the battle scars, Joel, to show for it. I'm delighted to be here. Thank you.
Hi, good morning. Paul Moffett, Encore One, Vice President. We are also a small group of 3 people. Myself, a president, and we have an associate as well. Encore is a family-owned investment holding company. Some people refer to the term family office. So there's some nuance there. Many family offices are set up and designed differently, but so I say family-owned investment holding company. We invest in lower middle market companies, 4 to 10 million of EBITDA. We're industry agnostic, geographically agnostic. We're really looking for good alignment with seller, founders, management teams that appreciate our unique approach that differentiates itself from traditional private equity. We don't have outside investors. It's a single source of capital, and it's kind of a long-term buy and hold strategy. So our group needs long-term capital appreciation and diversification away from the other businesses that the family owns, rather than any sort of shortened time frame for returns in order to return capital to investors. So makes us a little unique in that sense, but we still evaluate investments like a private equity firm would, so LBO models and that sort of thing. So a couple of similarities as well as areas of distinction. Thank you.
Hi, I'm Ty Schlobohm. I'm Managing Director and a partner at Mayfair Capital Partners. Mayfair is the internal buyout arm of what's called a multifamily office, where we advise on $35 billion. We would be categorically more in the middle market, where we're looking to partner either non-control or control with family-backed businesses that would have somewhere between $15 and $30 million EBITDA, said another way, an enterprise value of between $200 and $400 million. We currently own 4 portfolio companies and are seeking about another 4 over the next couple of years. Family office, we'll go into it later, and maybe the typical private equity construct have some similarities and certainly some contrasts, and look forward to articulating that. Thanks.
Thank you. Well, we just have a global question. The first one is, how do you describe the current M&A marketplace? And for some reason, Seema wanted to take this one on.
The reason I wanted to take it on is because Ty and I were at a gathering at Frederickson and Byron about a week ago. It was a gathering of M&A professionals, mostly bankers and lawyers. And on the big screen, they put up the deal stats. And the deal stats were pretty ugly. Deal volume down about 20%. For 3 reasons. Number 1, the high interest rates. That was the biggest driver. Second was economic uncertainty. So last year, there was lots of talk about a potential recession, and both buyers and sellers were very nervous about that. And lastly, there was the valuation gap that caused a lot of broken deals. So you have sellers who heard about the high multiples that were paid in 21 and 22, expecting similarly high multiple in 2023. And then on the other hand, you have the buyers who have the higher cost of capital, and they don't want to pay as much for the target. So those 3 ingredients caused a very soft M&A market. That being said, there was optimism in the room, right, Ty, about 2024, and we're going to talk about that a little later.
Sounds good. The other 3?
Sure. Well, Seema said it all, so those were my notes. I think there remains to be pent-up demand. The second half of 23 cooled as those LTM numbers comped down. The good 22 months rolled off and were replaced by worse 2023 months. So the volume was a little lower, and prior to that, there was a lot of volatility to sort of sift through. So hence the disconnect in valuation, oftentimes between buyer and seller. And sometimes the multiple doesn't change much, but the question is, well, what's the real EBITDA? What's the normalized EBITDA? So that's where there can be some, disagreement or natural tension that you'd always have between buyer and seller, but maybe it was a little more than more than normal. So, but I think there's optimism. Yeah, there's excitement for the second half of 2024 that these, companies are going to start growing again, or at least find their footing and stability, and there'll be more normalized supply chains, labor markets, credit markets, that sort of thing, with even more excitement, I think, and maybe it's industry specific, but for 2025. So good time to sell into a good market, I think, for sellers, and buyers can be more confident then as well.
Ty, would you agree? Anything new?
Not a lot to add on that. Listen, it used to be L plus 200, now it's S plus 500. That stings, right? And I hope it stings less with Powell and all that's going to go on. But listen, bottom line is that stings, and I hope it reverses, because things will slow down, and there's a lot of inertia out there, and I'd like the inertia to head the other way, with lower interest rates. But that's the pimple on the nose right now.
Yeah, I don't have too much to add. I would say maybe a little bit more pessimistic. I think 24 is going to be, maybe a little bit better than 23, but I think it's still going to be sluggish. That's kind of my thought. I mean, we're busy, and a lot of groups are busy right now. It's still really hard to underwrite a platform. You need to find lenders. There is still uncertainty going on. We have a presidential election going in 24, which is going to cause a lot of consternation. So I think it's going to be on par with 23, maybe slightly better. Where we're really active right now is add-ons, where it's really nice, and other groups have a similar playbook. We've already underwrote the space. We have our financing set up. It's easier to get a deal done in that environment. So our playbook right now is bang the drum on add-ons. That's a much easier path to get capital deployed right now. Grow our existing platform investments, make them stronger, going into a different geography, add a service line, et cetera. But I still think the market for 24 in my opinion, is going to be a little sluggish. Ultimately, I mean, groups like us, we own businesses. We eventually do need to sell them. I think LPs are becoming more anxious about getting capital returned to them. So ultimately, firms are going to have to exit their portfolio companies, albeit maybe at lower values than what they maybe thought they were going to exit at. So the engine is going to turn, and people will, especially groups like us, will eventually have to sell. I just think it's probably going to be more like 25 or 26 rather than 24.
Joel, I'm just going to piggyback. Can you talk a little bit about your control investments and what add-ons you're looking for?
Yeah, so we at Northern Lakes, we have 3 portfolio companies, all in buy and build. So we formed a company in the fire protection space. So for lack of a better word, people that are installing sprinkler systems, fire alarms, and then the more interesting part of the business is you sell really service or reoccurring service contracts to most commercial built environments. So we formed a company called Guardian Fire Holdings. We made 6 acquisitions across the U.S. We have 500 plus employees, 400 technicians. So we are looking for additional add-ons there. We have a commercial landscaping business out in the East Coast. We made 2 acquisitions, and we have a asphalt maintenance business in the Southwest region of the U.S. that we're actively looking for add-ons.
Thanks. We all know what happened with interest rates. Our first panel of the day, the banker could not make predictions. So I'm going to ask you all to make predictions on the interest rate environment. And let's see, who should we pick for that one? Seema.
Oh, wow. Well, I just want to summarize the whole interest rate problem with the story. And the story is, a few months ago, I was negotiating the sale of a manufacturing company and negotiating the purchase price. And we, of course, were going for 9, 10 multiple for our client, and the buyer wanted to pay significantly less. And as we were having this discussion about the proper purchase price for the company, he said, hey, 3 years ago, I was paying 3%. Today, I'm paying 7, 8%, and I need to show my limited partners an annual return of 18% per year. And in order to get that 18% per year, I need to pay a 7 multiple and not a 9 or 10. So, I mean,
There you go.
it really does have an impact. And I do think the Fed is going to lower interest rates. I can't say how much, but I mean, the Commerce Department just came out with a report that fourth quarter GDP was up 3.3%. The economy's doing well. They've tamed inflation. And so I think there will be pressure on them to lower rates. Not significantly, but enough.
Anybody else?
Comment on rates as well? Yeah, I was just gonna, that prediction sounds good for rates. I was gonna say for certain deals, say smaller ones, lower middle market, maybe the multiple's lower, and if it's a quality business and it's, able to support that service, I think you can find credit for it. I think finding the credit is maybe more important than finding the right rate, but that tends to be more important. And for larger deals, there's still kind of non-bank lenders that are supportive of, again, high quality, but larger deals at higher leverage multiples because the amortization is so light and you pay a premium for that. But I don't know that it's the rate per se affecting deals in our lower middle market, particularly founder-run businesses, whereas maybe larger companies can afford to be a little more patient in this rate environment. So I think it's credit availability and quality of asset is as important as the rate.
All right. Let's switch the topic a little bit and just talk about deals. Ty, I know you've been working deals left and right all year long. Has it been harder this year?
Yes. So we have a deal in market right now, one of our largest portcos. So I have the experience of selling a company. It's about 110 million in EBITDA, and we're hopefully closing at the end of this week. But concurrent to that, we're also buying a company, which also I hope closes at the end of the week with about 53 million in EBITDA. So there's a tale of two markets. And I forgive me if I'm being redundant, but there are companies coming out that have growth and up to the right, and their management team sparkles, and they have unicorns and rainbows coming out of their sims, and those deals are going quickly, and the competitive tension from the sell side bankers are creating a rapid, fast environment towards the higher multiple. The other tail of the tape are anything that isn't an A asset. In the game theory, and we participate in banker-led auctions, is that longer is better, right? I can do more due diligence. I can sharpen the pencil on the lenders, which is acute right now. I can bring in outside experts, and the competitive tension isn't there. Instead of an A asset, which could collect 50 to 60 LOIs, collects 4. And also seeing with the lenders having the ability to purvey information around the process gives a lot of input around where the other buyers sit and such. So this bid ask between a seller, family-owned business that may be anchored to 21 multiples, and the buy side, me, not wanting to pay those, time is on our side. So I purposefully try to delay that auction on the B asset. On the sell side, yeah, it's difficult, right? At a sort of, let's call it a $1.2 billion, $1.4 billion enterprise value that we're trying to sell this company at, the credit side is very difficult, even with the credit markets wide open. And buyers of that size, which are large private equity funds, are acutely focused on their first year of owning that company. If they buy a company in that first year, it turns into a dog rather than their projections. They are having greater repercussions because of the fundraising environment for them. As you all or we all know, private equity funds, they buy for 3, build for 3, hopefully sell on 7. They are also raising funds in there, and if they have a first-year platform that they've acquired that doesn't perform, it can only just sort of put a wrench into the gears of the whole process there. So the private equity buyers are taking longer than we want them, because they truly want to ensure that they buy this company and it does well in their first year.
Anybody else, your experience this year? 2023, I should say, last year.
No, I completely agree with Ty. I think it's a world of two markets right now. Companies are they're super sought after, and deals are getting done on a real bespoke basis. I think the businesses that have great margins, great management teams, are growing, huge addressable market. You don't need to go to 100 people to understand what someone's going to pay. You're going to go to the 5 logical buyers. They've already had a dialogue with that business, and the deals are getting done super quickly at probably maybe the highest valuations ever. But on the other side, the B and C companies, which candidly that's where a lot of businesses play, they're just harder to get done. They might be project-based, they're harder to finance, management team is not as consistent, or maybe a certain part of the group wants to retire after the transaction. Those are much harder to get done right now. So it really is a world of two markets.
I'm just gonna go right with you, Joel. Talk about industries a little bit. Are there any particular industries you're seeing that are hot from a volume perspective or from a valuation perspective?
Yeah, there are. I think, you know, one area that a lot of groups, I think, and I missed the earlier panel on corporate technologies, but I'm guessing why a lot of people like, or why the guys at Tonka Bay like that business, there's recurring revenue there. And I think anything that has recurring or reoccurring revenue is hot. You know, we mentioned uncertainty is not very good for deal making. If you have recurring revenue, you're taking out some of the uncertainty through 3 to 5 year contracts. So recurring revenue is huge, and you know, it's always been a really big thing for private equity. Anything in the facility service space is big. So that's HVAC, plumbing. We own a fire protection business, which is facility service, landscaping. Big markets, highly fragmented, tons of white space. You could potentially build your way into a bigger business there. And a lot of those businesses have more non-discretionary spend. So whether you like it or not, you gotta, you know, your HVAC needs to work. In the summertime, you gotta get cold. In the wintertime, you gotta get warm. So those types of industries, things break, you need to get fixed, and you're not gonna do it yourself. So the, you know, anything facility service with non-discretionary spend with a recurring revenue element are really hot spaces.
I'll just add that what we see is a lot of interest in manufacturers of industrial products, and I think part of the reason for that, especially if they're U.S.-based, is the reshoring of bringing manufacturing back to the U.S., so that's a very hot market.
Good point.
Yeah.
Paul, Ty, anything to add?
We love, from a macro standpoint, health and wellness, and maybe you'll giggle, maybe you won't, but we love med spas. There is a community of men and women that have discretionary capital, disposable income, that are willing to augment their aesthetics regardless of their recession or not. And these are multiple units that can be rolled out. They're cash cows. Anybody in here owns a med spa, come up after. I want to own it.
Yeah, that's it. Large, addressable markets, growing demographics, recurring revenues. So those are all the important things, and avoid things like obvious things, you know, customer concentration, project-based work, that sort of thing. And in manufacturing, of course, if you've got aerospace and medical, you know, certification, that kind of thing, that can is maybe still project-based in a sense, but there's usually contracts and service contracts tied to that that's pretty sticky and hard to move. So those are certainly attractive and hard to offshore as well. So good, you know, domestic manufacturing and engineering can support, you know, that the valuation and the kind of long-term commercial viability of that business as well.
I think one we missed is healthcare, just given the demographics and the graying of America. Any business or service that serves the graying of America.
Good point. Paul, what's new with deal structures?
Well, I don't know that there's a massive macro trend, and it's circumstantial based on A and B assets, but you know, I think over the last 2.5 years, and maybe still continuing, the concept of earnouts to kind of bridge the valuation gap or expectations of sellers from 2022 when they had their best year ever on the highest pricing that they just enjoyed off of the back of inflation. And they claim to be holding on to it, but the volumes are down and the rest of the market's trading a little lower. So, you know, in that case, an earnout might make sense if you still have, you know, great other elements or characteristics of the business and, you know, strong management team, or maybe even the sellers rolling over or sticking around to run the business. You know, there could be good alignment there on an earnout if a seller thinks, you know, business is going to come back and, you know, at least be, you know, stable. You can kind of use that and earn out to bridge a valuation gap. And then the other opportunity is maybe something's going on in the industry and that business is booming, but it's a seller needs to sell. Lower middle market companies, sometimes they can't afford to be patient. Founder, seller run businesses, there's health issues, there's retirement needs, there's other needs for liquidity. And so despite the macro challenges, you still need to sell, but business is good. And if they don't want to leave, money on the table, an earnout can be part of that deal, and that's not new, but maybe it's a larger percentage of the overall enterprise than it used to be, say, in the old days. I think that's probably the biggest element. And then, I guess overall, just to kind of bridge performance volatility, that kind of thing, prove out the consistency of earnings, that new level or bottom that the business and the sellers, claim to have found. And then I guess as far as another feature, maybe the acceptability of seller financing to kind of bridge a financing gap as well. And I don't know that seller financing rates have changed much, but they're probably pretty close parity to what bank rates are, that SOFR plus 5 these days. So maybe an active seller who's going to remain in the business is willing to take back a larger seller note than they would, and they feel confident about the future and the viability of the business, and that could be some extra proceeds in their pocket if they wish to not fill a valuation gap, but just a financing gap as well. So those are two features, earnouts and seller notes.
Yeah, I do agree. I think the last year or two, I think the acceptability of the seller note has increased pretty significantly. So a lot of 3-4 years ago, it was a harder thing to get past when negotiating the deal. But now seller notes are much, and with SOFR plus 5, I mean it's 8-9% interest. And if you're selling your business and you're going to have a big liquidity event, in a way, where else am I going to make 8-9%? And in something that you really understand and believe in. So it is it's becoming more and more acceptable in deal structures right now.
And as bankers, we really dislike earnouts, and we tell our clients, be happy with the amount you get at the closing. If you earn an earnout, fantastic. Consider that the icing on the cake. But there are so many lawsuits in terms of earnouts and how they're calculated that we try and avoid them. It's usually a last-ditched effort to get the deal to the finish line.
Yeah, and we incorporate them, and we don't like them either. I mean, it's just a way to get a deal done. But the last thing we want to do is have a potential fight with a future partner. We try to avoid them. If anyone's selling a business, really negotiate how the definition of whether usually it's EBITDA or revenue, but really negotiate how that's being defined. And the big thing is, we acquire a business, we invest in a business, we look to grow it. So, year one, we're adding talent to the business. That individual may be looking to maximize that near-term earnings. So there's always that pull, kind of the give and take in that first couple of years of the earnout period or first year of the earnout period. So really negotiate that, really understand if have carve-outs of potential new talent that you're looking to bring into the organization, just so it's clear that if we're adding $300,000 of cost, that is maybe carved out or added back to the earnout. So really be smart about negotiating that, because it can be, we try to avoid it, but it's sometimes inevitable to get a deal done.
And we've never done a deal with a seller note, but if that was the case, I would tell our client, look at how much senior debt is going on to the company going forward, and see if there's enough cash flow to support paying your subordinated debt to the bank.
Mm-hmm. So suspicious, Seema.
Optimistic.
You have to find the right partner.
Yeah. She plays both sides.
Those are good advice, yeah.
I think the other thing is, what does the former, seller, what do they control after the deal? And making sure that if it's EBITDA or revenue, they have some control. Otherwise, they're going to be judged on, a lot of different adjustments.
And that's right. They typically don't have control because they've sold 90% and they get to go to a board meeting. But other than that, the company is no longer theirs.
Right. Well, I think it's time to talk a little bit about the different models between private equity and family offices. And Paul, you alluded to even within the family offices, there are different models. So maybe, Joel, why don't you kick it off, and then we'll take it over to Paul and Ty.
Sure. So, fundamentally, we're pretty similar in a lot of ways. I mean, we're investing in privately owned businesses, both committed capital, private equity funds, and family offices. So there's probably more similarities than there are differences between us. But I mean, if you look fundamentally, what is the biggest difference? It's really hold time. We have a committed capital fund, so the money we're investing, unfortunately, is not mine. It's our limited partners. So my job is to make good investments, grow the businesses, and then within a, let's call it a 5 to 10 year, 12-year period, exit those businesses, hopefully at a 3 to 4 times multiple of what we've been invested. So that's what my job is. So ultimately, what that means is we have a finite time with the business. And that's really the biggest difference. Where Paul and Ty invest, they can sit down with the business owner and say, we love your business, we want to be a part of the business for forever. They can own a business for 20, 30 years, or we ultimately have to give the money back and deliver a return to our investors. So fundamentally, I would say hold period is the biggest difference between us. What that entails is we need to act fast when we acquire a business. So I'm not speaking, I don't know exactly how they operate, but I mean, we try to move pretty quickly. So I mean, when we partner with a business and invest in a business, we're really hyper focused on growth, profitable growth. We like high margin growth, but we're probably, I would guess, maybe quicker to act on certain things, whether it's making that acquisition, going into a new market, really figuring out the team that's going to lead the business upon our sale if the founder or the current team is going to be rolling off. So we need to move quicker just because our time and our life cycle with the business is shorter. So that can be really exciting for teams where we're looking to grow. I mean, we're not going to own the business for 20 years, so we're looking to make an impact in a pretty short period of time, which I think is it's a fun time. We look to scale businesses. That can be rewarding, just running a bigger business. Obviously, that creates new opportunities for other folks at the business, which can be exciting from a career development standpoint and from a financial standpoint as well. So we're probably a little bit acting quicker just because our time with business is shorter.
Yeah, no, all good points. I mean, we're still evaluating the investment as of a private equity fund would as well. So expecting growth and profitability, and certainly that's expected if we're going to pay a premium value and the seller has an exciting liquidity event. But said another way, as Joel alluded to, we're also trying to create, meet another emotional need that the seller might have for the business. Maybe they have a very patriarchal attitude towards the company that they started and the people that they've employed for many years, and they'd like to see that legacy continue that they've built and long-term job and wealth creation opportunities for the people that they've left behind. And also the disposition of the seller that where our message resonates compared to others is maybe, right or wrong, they're not comfortable. They've heard something on the news with the traditional private equity model, but it exists for a reason. It creates a lot of value for sure. So they're not sure about that. They'll be damned if they sell out to the big strategic guy they've been competing against for 40 years. And they're first-time sellers. They haven't been through this before. So I think a family office or generally a long-term investor kind of represents a softer landing, a less threatening partnership perhaps. And, they still want to get paid for all their years of work. They still want to have an exciting liquidity event. So we can fulfill that unique need, from that unique buyer. And then for management teams, it's also long-term job prospects with growth and profitability. But if they don't necessarily have to live through the buy-sell cycle in the future. They can see themselves working here at this company long-term. Our group or another long-term investor is going to provide new job opportunities for them, growth, reinvest in the company, maybe do things the seller hadn't done in the past because they were, hoarding cash or taking distributions as they were nearing retirement. So that can be exciting, and then we can set up certain long-term reward programs that they also hadn't enjoyed, under the prior ownership as well. So, and representing a soft landing. So there's elements of that. To the extent there's some cyclicality in a business potentially or a macro environment, we've got not only the pocketbook, but the long-term vision. We can invest through those cycles and maybe have the chance to come out stronger long-term and not have to sell a business at an inopportune time or an unnatural time frame as well. So those are just some features, I guess, behind the nuance of what it means to be a long-term investor that might be attractive to some sellers in the management teams and their customers, by the way, might find it helpful. It's usually not, a deal breaker, but it's a nice to have as well, a way to, market the business or promote the business potentially.
Yeah, I would just add, maybe the only thing that wasn't said is typically family offices will run a little lower on the leverage ratio in contrast to a typical sponsor. But I would say that the only requirement to call your family office, a family office, is the ability to say family office. So, not to punch against myself, but like I think people have almost a Pavlovian response to family office. They're big, they're multi-generational, super wealthy, they're patient, long-term owners. That's great. Think that when you leave the room, but just like it's an overused term right now. So be reticent when someone comes of your company and calls himself a family office.
Well, just to add to what you said, Ty, wouldn't you say there are all sorts of shapes and flavors of family offices? There are some billionaires who will just write you a check for $50 million and say goodbye, good luck, call me if you have questions. And there are others that really act like a private equity fund and get more operationally involved in the business.
Well, you need an awesome banker to be able to vet that for you.
I'd say that's right. Yeah, there's, and the expectation sometimes is what Ty said, but also that maybe it's the rich uncle money or the dumb money and that kind of thing. But I'm not a family member of the family that I represent, unfortunately. But I'm an employee and a manager and a fiduciary. So we're an institutional investor trying to make really smart decisions. So there's still going to be a high level of scrutiny and due diligence, put on the business. Trust but verify kind of approach to due diligence. So all the quality of earnings and the heavily populated, data room and the market study and the voice of the customer and the environmental and the real estate review and everything else. So it's not I imagine, much different or easier process per se, but, hopefully there's, some level of comfort or trust or some other reason that, we, buyer and seller, have chosen to work together.
About a year and a half ago, we talked a lot about family offices partnering together. Remember, Seema?
Yeah.
I think the Polad family and others were partnering on deals together, talking about deals together, going in on deals together. So, Paul, do you see that still happening?
I've heard the same thing, but so historically, Encore won. I guess one thing that makes us unique in this euphemism, this world of family office, or this thrown around term, is that Encore One's been around for over 20 years. So it was pretty novel in 1999 to have a family office of some shape or size making direct investments. I guess that's the other feature that's unusual. And so, back then, we're chasing still $4 to $10 million of EBITDA. Private equity, there weren't a lot of professional investors in that space, so it was pretty novel what we're doing. And nowadays, there's lots, and they come in all kinds of shapes and sizes and stripes. So historically, our mandate sort of informally has been, 100% buyout of a seller-run, kind of founder-led business. And that's evolved a little bit. So in the past, I have been asked, do you want to share in this deal and that kind of thing? And it's no, we don't want to be a minority co-investor in your deal. We just want to own 100%. We don't even want to share the rollover with, sellers perhaps. But all that's evolved a little bit, I think, in Encore 2.0. So an initiative, I guess, Jay, to your question, for our group is not only to pursue great direct opportunities, banker-led processes, but also potential co-investment opportunities where, say, our group, Encore One, would potentially be a minority co-investor in a larger, led deal by some other like-minded long-term investor, like Mayfair, for example, which allows us to chase larger vis-a-vis, or which is another way of saying higher quality deals, still put, capital dollars to work with a trusted partner, where there's an institutional investor involved and keeping an eye on our dollars and on the board as well. So yeah, hopefully there will be some more sharing opportunities, but it's pretty clubby. The family office world is sometimes hard to find or identify, or because they come in all different flavors, put exactly your finger on, do we have really perfect alignment with what we're looking at, and is there a chance to share deals? And I mentioned we're a small group, probably smaller than a traditional private equity fund with a similar size capital base. So sharing resources, both, people as well as dollars to pursue deal opportunities is an opportunity, I guess, for us, and it could be helpful for a seller to know that, not only am I getting this one investor, I'm getting these two investors that are both maybe really strategic and knowledgeable about a certain space or business and that kind of thing. So we I think, the royal we, as like family office groups generally, I think, we'll look to share more opportunities going forward for sure.
And one thing, we're a traditional committed capital fund. We do a lot of work with family offices as well. We have family office and direct limited partners in our fund. And we also will, depending on maybe where that family made their wealth, we will sometimes work with them as co-investors on deals. If there's an opportunity in the insurance space, let's say, we don't know that much about insurance, but there's people that do that have made a lot of money in insurance. So we're more likely to send that opportunity to that family office and potentially co-invest with them, or they would co-invest with us. We would be the deal lead, but they would be a co-investor in that deal. So we work with, as a traditional firm, we actually work with family offices quite a bit.
To quote Jay-Z, we've got 99 problems, but capital isn't one. So, for us to partner with another family office, they've got to bring something to the table, industry expertise. They know the Michael Jordan of board directors or something like that. If you see 5 family offices coming at your company, I'd be suspect that they're looking for capital. And if they're so big time, quote unquote, family office, why they need to come with like 6 of them, because that's a lot of chefs in the kitchen.
Good point. Well, this is where we put Seema on the spot.
Uh-oh.
You ready? So.
This isn't a surprise question.
No, I saved that for later. This is, it's actually, I'm going to direct it toward Ty.
Okay, good.
So I know you talk a lot about investment bankers and your enjoyment of working with investment bankers. Can you shed some light on the pros and cons of working with investment bankers, both on the buy side, sell side?
Yeah.
I'm ready.
It's coming at you, see. Any other bankers in the room too, get ready.
Maybe speak up a little bit, it's hard to hear.
Yeah. So on the sell side, right, you've got a company and you're going to bring it to market and you're going to hire an investment banking team. Unequivocally, go that way, right? Because there's enough dispersion at the auction where, just game theory, right? If that banker is going to put together a buy list of 200 or 2,000 and 8 people show up at the LOI, that banker's going to, outside of a host of other things, try to get that competitive tension to the highest price, right? They're also going to be your psychological crutch. They're going to give you momentum to get through the finish line when you are like, why did I do this? I hate my banker. I hate my life. I'm working a 80-hour week and I can't tell my employees, all the milieu, the milkshake of stuff you're doing. And listen, the smartest guys in the room, the private equity studs, they sell through sell-side investment bankers, right? They're no dummies. We all try to buy outside the process, right, to try to get a price. But, I would love to fight with anyone on not hiring a sell-side banker on your company. I'd die on that hill. Now, the buy side, that's a different story, right? So, I'm a buyer in an auction. Seema's the sell-side banker, and I'm trying to, give her all the stuff why I should finish the auction with the winning bid. We have a portfolio company that I alluded to that's in the market right now. And a number of the buyers, there's like 8 of them, have hired buy-side representation. And the reason they do that is to either consult with them on a complicated structure. In the case of this company, we brought it out in 21 to sell it, and the credit markets closed, so we didn't sell it. So a lot of the bankers that lost on that bake-off had intimate knowledge about the process, where the warts were, how to make the management team love them, not dislike them. And also, you know, they're collecting information. The buy-side bankers that are working with the 6 or 7 private equity funds looking at this company, they are like pet detective. They're out there trying to find out tidbits of information, where the, you know, buyer is going to land, and they're probing the senior lenders about what information they can get out of them. It's, you know, I don't like them, but I would want to have them on my side if I'm running at a company that's competitive. So I guess the answer to both mine is, you know, the bankers add value, more so on the sell side than, you know, sort of a buy side mandate. But, you know, anybody who wants to fight me on that, use a sell side banker. You're going to come out ahead emotionally and hopefully empirically.
Anybody else?
Yeah, I think Ty alluded to the kind of the direct proprietary deal, and everyone is always chasing that. I mean, in theory, it's great because you're kind of the only one at the table, but we still like when there's some type of person involved. I mean, we maybe have a little bit different model where we're acquiring control of the business, but we're acquiring usually 55 to 70%. So that person that is the owner of the business generally is staying with us post-close. And as we all know, it gets pretty heated during due diligence. We're negotiating, and it's nice to have someone kind of playing in the middle there, holding everyone accountable, driving the process. It's great to have someone, you know, just it's super labor intensive selling your business. I mean, there's long hours. You're running a business. To Ty's point, you're generally keeping those discussions pretty close-lipped, so not a lot of people at the company know. So just from a workflow standpoint, it's really nice to have a banker involved from our standpoint too, just to drive the process and make sure things are getting delivered. So, you know, in theory, I think everyone would want to buy something direct, and we have done that. It is nice sometimes having that middle person in between to make sure things go smoothly.
I guess the last thing, not to be redundant, but add on, for us, we're partnering with family-backed companies, and we're going to partner with them for 7, 9, 12 years. Both of us want to know that we achieved a market clearing price as we're, you know, married for the next 7 to 9 years. If it comes out that we bought it 2, 3 turns below market, or we paid 3, 4 turns above market, it's just going to be, you know, an elephant in the room. At least I know if it was a banker-led process that 100, 500 participants, you know, executed at a market clearing price, and it's just a little more comfort, and it makes the partnership on a greater foundation.
I'll just add to what Ty said. I think that it's a very high-stakes game, and there's a lot of money involved, and there's a lot of emotion involved, especially for my clients, most of whom have spent the last 30, 40 years building their business. And our goal is to get the deal to the finish line. And there are inevitable hurdles, discussions over valuation, earnouts, all that. And we do a lot of hand-holding on both sides, and we believe there should be a win-win where the buyer feels they paid a fair price and the seller feels they got a fair price. And that's our 100% objective, a win-win.
I think just to follow up, I mean, it's really important to hire good representation. That includes investment bankers, but probably just as important as legal representation and accountants. It's, you know, hiring your cousin who does real estate work to sell a $50 million business that you've owned for 40 years is not probably the best decision. They have your best interest in mind, but they're just not as flaccid on what is market. And that's really important to understand kind of what is acceptable. Here's what a business of this size with this sophistication, what's expected. It's just going to make the process go a lot smoother.
Well, we don't have an attorney on the panel, so this is your moment to be the attorney. Any new legal or risk management trends related to documentation or deals themselves?
I can start. There's a lot of due diligence around cybersecurity, around data privacy, around AI. The lawyers ask our clients, have any of your employees been the victim of phishing attempts? Have you had any ransomware attempts? What insurance coverage do you have to protect against these? If the company is using AI, are there any vulnerabilities? And speaking of AI, I did speak to a partner at a top law firm in town, and he said they are using AI to review contracts. They are using a tool called Krier, and I went and watched a YouTube video of Kira's capabilities, and it blew my mind.
Those hourly rates, it's all AI that you're paying?
Yeah. Does that speed up the process?
Nope. Yeah, it still takes the same amount of time.
Good. Well, I'm a little conflicted on this one, so I'll let you all answer the question. Are you seeing more sell-side due diligence? Are you seeing more help from maybe an outside CPA firm with the sellers getting prepared for sale?
Did you want me to answer?
Sure.
Okay, on the accounting side, we're bringing a company to market next week, and for the first time, we hired an accounting firm to do a sell-side Q of E. And for those of you who aren't familiar with the Q of E, it looks for anomalies and one-time events that skew the company's earnings. And as you accountants in the room know, the more a company follows GAAP, the higher the quality of earnings. So yes, and given the macroeconomic conditions we talked about, inflation and supply chain and higher interest rates, buyers are putting our clients under a microscope. And we, like a real estate agent who gets your house ready before you go to market, we send them an Excel spreadsheet, 3-4 pages. It covers things like finance, operations, intellectual property, HR. We want to make sure that our clients have all this data at their fingertips so that when the buyer is conducting their due diligence, that the information is readily available.
Yeah, I think in almost every kind of banker-led process, there is a sell-side QB report that's table stakes now. And you know, even when we as a firm sell our companies that have been audited for 10 years and are more institutionally ran, we still will hire a firm to do a sell-side QB because that's just what's expected in the market now. So it has become just part of, just like a SIM, every deal has a SIM or a memorandum, every deal now has a QB generally. And we still do, I mean, even though we receive a sell-side QB, if we get the deal under letter, we'll still do a QB ourselves. So there's a lot of double fees, but that's just what's standard in the market right now.
I was going to say a lot of Encore One's deals, I guess, or maybe a disproportionate amount compared to most firms have been direct. So in those cases, usually the seller is not, who we're negotiating directly with, is not getting a sell-side QOV unless they have a really, really thoughtful, progressive accounting firm like BWK. And which is great to have. More information, more transparency is better than less. So in that case, between us and our resources internally, as well as hiring outside QOV CPA firm help, we'll do as much of that as we can, and of course, share and be as transparent as possible with our seller. But otherwise, to Joel's point, yes, I would find it unusual not to get the sell-side QOV from the investment banking-led process, although I've seen a couple, surprisingly. But so I think it's pretty typical.
Thematically parallel, I'm starting to see sell-side processes come out with market studies, independent market studies. So if you're in some sort of industry or sector that requires some learning curve, similar to the Q of E on the preventative maintenance, if you will. Firms like LEK or E&Y are doing these market studies as a way to, be enzymatic at the auction, but also, have this independent thought from a 50,000 foot about the industry. And that juice seems to be worth the squeeze as both the buyer and doing it on the sell side as well. But it's on the same path.
Awesome. Well, that's kind of the end of the prepared questions. So we like to leave a little bit of time here, 10 minutes or so for questions, and then we got about a 5-minute wrap up after that. So I know Brad, Mary's back here with the mics. Any follow-up questions, please? Eric? He's behind you. She's behind you.
Not to be back again, but thank you. Thank you, panel. Appreciate it. Quality of earnings is an interesting challenge, but another problem is breakup fees. Amazon was going to buy iRobot, $94 million, breakup fee for them. Are you seeing more deals that need a breakup fee or some sort of fee, or have you even done them, or can you even share that? Thank you.
I had 2 deals this year where opposing counsel proposed an RTF, basically a termination fee. And I think it was a misconception that we were in a quote-unquote committed vehicle with $612 million in there. We just have to pull from the families. But the second time I saw it, I think that there is a bit of a fear of not necessarily a breakup fee, but just that the failure to intersect on the auction, and that the seller or the selling entity feels like they should be compensated for not only their time, but the potential adverse impacts to their company, if you will.
I think on the buy side, we would never enter into a breakup fee agreement. I think on the sell side, where we have contemplated it, we never did it, is if you want a few parties to run forward and start spending, both, maybe you have 2 parties that both submitted LOIs and we're gonna run them to signing the purchase agreement, we have contemplated reimbursing one of the parties whoever's not selected for their fees that they've incurred, legal, QOV, so maybe that's $500,000 or so, but that's probably what we would do on the sell side. But on the buy side, we're just not big enough to agree to something like that.
Would it be safe to say it's probably more common on bigger size transactions?
Yeah, bigger public ones that are going to get announced in advance, and that would be detrimental to somebody's reputation.
Yep.
Good. Must have a couple other ones. Sir, up here, Mary.
Yeah, I can probably just Hi, I'm just curious, you mentioned about direct investment into deals, but it seems to me that a lot of family offices have also morphed into kind of a fund of funds approach and picking, quality teams to run deals. I'm just curious how you guys feel about that structure versus direct investment.
I know you got a lot to say. Let me start.
That's okay. We got time.
Well, as we said earlier, every family office is different. So in our case, Encore One is just the direct investment team, and then we've got another team that manages those fund managers that are doing that and also investing in public market securities, and another group that does real estate investing over here. You might go to another family office group, and they might have one manager kind of making decisions across all those different asset classes. So it depends how they're set up, but it's not a bad idea. And I think philosophically, the Round Horse family ultimately, who are the beneficiaries of our family office group, they're just entrepreneurial, but culturally, so they want to own long-term and hold and support these businesses and create, again, that long-term capital appreciation, diversification, of which one sliver of that it's going to be direct investing, as well as maybe another sliver being the fund manager investor.
So yeah, we invest in 4 to 6 buyout funds a year, and almost always those buyout funds are in areas or sectors where we don't have any expertise. That would be life science, healthcare IT, aerospace and defense. And we make those also expecting something called co-invest, where we can get a no fee, no carry equity allocation to where we have a limited partnership interest. So we do invest in private equity funds and co-invest alongside it. But like I said, mostly in areas where we don't have any experience, and that experience is required to be competitive in that sector.
Now, Ty, I promised you a technical, complex question, no softballs.
Oh, there you are.
Here it goes. Is Mayfair truly a family office?
Yeah, like I put the asterisks up, all it requires is to say family office. The definition that I will use in front of 200 faces of family office is that we're not a committed private equity fund. But we serve 500 families. That represents $35 billion, and really it's a co-op of single family offices without going into details. And they want to have an internal team that's buying direct investments for them. You would see a similar setup to the Carlson family that does Carlson Partner Capital, the Round Horse family, and the list goes on. But we're a multi-family office structure. So again, you can drive a bus through the definition of a family office, and I use it
question.
only when it's advantageous to my own
good.
mandate.
Tom, you got any other zingers? No? You did.
We talked a little bit about interest rates. I've kind of gotten this sense in other areas. Do you get the sense that whether buyers or sellers believe or think or are waiting for interest rates to not only come down, but go back to kind of pre-2022 levels, which probably isn't likely, but I've seen that, a delay, a drag of feet, because I think people think when they hear interest rates may be coming down, they're thinking really far down.
Didn't sound like it.
I'll just say, whenever we talk to business owners, and we talk to about 100 a year, what we tell them the most important thing in terms of timing is not about interest rates. It's about, let's look at the trends in your business. Let's look at the revenue trends and the EBITDA trends. And you want to sell when those trends are all going up. That is more important than interest rates.
Sir.
Hi, I've got one more question. Our ecosystem for decades was incredibly successful in medical device. I think we competed with Israel to be the #2 ecosystem behind Israel for all those decades. I'm curious, at the end of a long morning discussing this, that medical device hasn't come up. I'm just curious, within that area that Minneapolis has so many successful startups and whatever, I guess there's been some kind of inflection into more software deals and insurance kind of deals and things that don't have the hardware challenges. But I'd be curious, with such histories up on the stage, can you guys talk a little bit about the current ecosystem for medical device and why?
I can.
Go
Because
ahead.
when we first started Athlon, we did a lot of medical device deals. And I don't know if anyone in the audience knows Manny Villafana, but he started St. Jude and Guidant. And he said, it takes 20 years to build a medical device company and a couple of $100 million in capital. And on top of that, you need FDA approval. The hurdle is too high. And so that's why there isn't as much investment in medical device, in my opinion.
Yeah, a firm like us, when we would view that to be, you have to really have that expertise to understand that. We would invest in a company that is does injection molding, selling into a medical device company, so more of a supplier to a medical device. But a true medical device, there's a lot of regulatory, and you really got to understand what you're doing there.
Other ones in the back? Greg in the back, I know you have one. Brad, would you make your way up if there's no more questions? Oh, we have one.
So jumping back to the topic of reoccurring revenue, we're seeing oversaturation, at least at the consumer level. There's apps out there now to cancel all your subscriptions because you have so many. Are we starting to see that? Are you starting to see that at the company level as well, and people wanting to move away from that?
I think recurring revenue in this context for me is sort of reoccurring service revenue. You're selling a consumable product, it needs to be replaced, facility needs to be cleaned. From a regulatory standpoint, your fire and safety equipment need to be checked out, annually or quarterly or whatever it might need to be. So that's kind of the recurring revenue versus the sort of consumer model that we think about, renewing an app on your phone.
Yeah, I would say the buy-side community, when it comes to reoccurring revenue, when it applies to like a software company in the second panel, those ARRs or MRRs are coming a little bit back into sanity level. Those price to sales, another way to say it, of 10 times plus. And I just don't think that those buyers are able to grow the companies to achieve that multiple. And I think the community at large of buyers are starting to become a little more tepid on, paying those multiples. So, software ARRs, MRRs are coming back into normalcy would be my observation.
Here he is. He's got one.
Since Jay baited me, I'm going to come up with something. As a follow-on to the medical device company, it looks like, or a question, looks like there's been a shift to wearables, telehealth, and mobile health. Are those segments more attractive to you for an investment?
Not to a group like us. Once again, we would kind of fit that into more, we invest in pretty basic businesses. I mean, it's fire protection, it's asphalt pavers, it's really easy businesses to understand. So we're probably the antithesis of those type of businesses. That's just not where we focus historically. I don't know about.
Yep, no, I agree. It's kind of mature industrial companies that have been around for 40 years that with strong management teams. So not an original thought, maybe CapEx light as well. But that's what we're targeting. I mean, there's a world certainly for wearables, and those are exciting spaces, but it's just not what we're familiar with, and what we're targeting kind of, again, long-term sustainable companies, not knowing where those trends are going to go necessarily.
Yeah, I don't have an original thought, but I've read a couple interesting things about it. Coming out of CES with the generative AI, in contrast to the LLM side or the language models, there's some interesting wearables or gadgets that are trying to bring the execution of AI into one component. Think of, how cool the iPad was when it came out, but to take generative AI to complete tasks in a wearable seems to be the holy grail right now. There was one product at CES that got a lot of attention trying to achieve that. You can look it up, Google CES Cool Gizmo AI, and I think that's where the money's going to go, but not an original thought.
Thank you. Anybody else? Okay. Thank you very much. Awesome panel. And thank you all for filling the room today. I think it's been suggested next year we do the Target Center, Brad. Target Center. Really promote it. Circle this time next year. We're trying to make this a recurring January, February time period now. And if you have any questions at all about PDA, FEI, let me know. I'll get you to the right people. Individual membership, corporate membership, or strategic partnership. We have all three. Both organizations have all three. So with that, I'd like to just have Brad wrap it up. We didn't talk about the upcoming FEI events. Thanks.
Well, first, let's all thank Jay. He put this whole thing together. This is his baby, so thank you, Jay. And our amazing panelists, all three groups were stunning. I, of course, want to thank all the FEI members, all the PDA members, and, of course, our amazing strategic partners. FEI is able to do 2 to 4 events a month because we have amazing strategic partners who support our programming and the content, and it's just fantastic. And I am going to mention 3 events that are coming up quick. We have a career development event led by one of our strategic partners, Jennifer Carlson, with Robert Half, and that is on February 13th in the morning. We also have a terrific event on the 15th, presented by Boz Bostrom, and our great strategic partner Legend is producing that event. And on February 22nd, Dan Florina is a Fastenal. He's going to tell his story, and that should be fantastic. And that's from 4 to 6:30 on the 22nd. Again, thank you all. You are an amazing audience. I love to see the energy when you're all socializing, and your questions are always thoughtful and intelligent. So thank you, thank you. Have a great day.